Right. Good morning, everyone, and thanks everyone for attending. I'm just going to give a couple of short number of minutes just for other people to just dial in, just in case we've got a latecomer or two. So we'll start shortly. Thank you.
The realization was all.
Right. I think in the interest of time, I think it's important we get started. Good morning, everyone. My name's Edwin Selbst, and I'll be taking you through this ethics course on Are You Really Independent? And what we've got on the agenda for today is just an understanding of who actually writes the code of ethics, just understand from an IFAC perspective, what's the structures that are at play. We'll be looking at the RBA code and some of the changes. We'll be looking at the effective dates. Most of our discussion will be on the enhanced conceptual framework and the professional skepticism with the fundamental principles and how those changes have found their way into the standards, to these new independent standards. And then we'll be looking at briefly some ethical challenges at the end. From a logistics point of view, just wanted to confirm whether or not, first of all, everybody can hear me. Just if you can just raise your hand, if you can hear me. Great, I see some hands going up. Fantastic, thank you. And then from the perspective of just timing and that, I am going to be running for about an hour. We do have quite a full program this morning. Then we'll take a 5-minute leg stretch, literally a 5-minute breather, walk around, get some fresh air, whatever you need to do. If you're in a working office, take your mask off if you need to. And then we'll then go for another hour. That will take us to around 11 o'clock. I'll try and time it as close to that as possible if you need to make calls. We'll then take a 10-15 minute tea break, grab something refreshing for yourselves, and then we'll hopefully be finishing off at as close to 12 as possible. Not sure if there's any questions you have regarding the agenda, if there's anything that people are wanting. I do see that some people have still got their hands up. If you do have questions, I'm comfortable for you to unmute yourself and raise them. I will also be looking in the chat to see if there are any questions as best as possible. But I do encourage you to unmute yourself and ask the questions, and please, that way it'll just make things a bit easier. But if you prefer the chat, like I say, I'll try and watch that. just from a show of hands, if I can just understand from the audience, just to understand, for those of you that have got your hands up still, maybe you just want to lower them, and then how many of you are in audit, be that public practice, you're running your own practice, part of a firm? If you can just raise your hands. Just please keep your hands up. Great. Okay, so I see that's pretty much the majority of you. Great, thank you very much. Okay, and then those of you that are in more of a corporate space, if I can ask you to raise your hands. Okay, great. Okay, so thanks very much. So right, you can lower your hands, and then please, like I say, if you do, you're welcome to raise them, ask a question, or post your questions in the chat, please. Great, you can just ask everybody just to mute themselves unless they've got a question. Great, super. So then I think let's then get on with today's learning, and let's understand then, for a start, where do the code of ethics come from? How has this given rise? What are some of those changes? And then what is it that we need to concentrate from an independence perspective, and applying professional judgment, and then we'll have some case studies at the end. So who writes the code of ethics? So sorry, just one other question I just wanted to double check, just so that I'm familiar with the audience. If anybody is from a country other than South Africa, if you could just please raise your hand, just so that I know if we've got any international people. Okay, fine. Thanks. I do see some hands going on. Okay, great. So thanks very much. All right, we can lower the hands. Thank you. Okay, so from the perspective of the code of ethics, so the code of ethics is developed by the International Federation of Accountants, and the International Federation of Accountants has various components. The two major components are the IAASB's International Auditing and Assurance Standards Board, and they issue guidance in the assurance space around the auditing standards, around the international standard on quality control, and other guidance around related assurance engagements, compilation engagements, etc. That all comes by the IAASB. And what we have is also an organization called the IESBA. And the IESBA is the organization and a separate body that writes the code of ethics for international professional accountants. And the way in which they get their mandate is because of the robust consultation and development process that takes place by IFAC. I mean, you've got people such as bodies such as the World Bank, the International Federation of Independent Audit Regulators, organizations from international governance space sitting on those boards. And then we have the IAASB, where you've got trustees, and then you have the ethics board, which also has a representation from countries around the world, In South Africa, we are fortunate enough to have somebody from the RBA, their standards department, a lady by the name of Sadia. I think her surname is Adams. I just forget the surname. Just escapes me at the moment. And Sadia sits on the IAASB's, sorry, on the IFAC's IESBA. She's a technical advisor to somebody. No, sorry, she's actually recently been appointed as a member herself. And the reason I'm telling you that is because when it comes to international changes and South Africa being up to date with that, there's representation. My understanding is she doesn't represent the South African contingent, and therefore we do have a significant influence and direct input into the changes that have happened and that continue to occur. These appointments are normally for a period of 3 to 4 years, and they are, if I'm not mistaken, they only allow one further appointment. I do see some hands up. I don't know if those are any questions or if those are just hands remaining from before. If somebody's got a question, you can unmute yourself. Otherwise, if you can just lower your hands, please. Okay. Don't hear any questions or seeing the hands going down, but okay. If we can just ask you again to please lower your hand just so that I can see if there are any new hands going up. That's the purpose. So when it comes to the ethics and how are ethics different from morals? So we've run courses in the past on that. And briefly, ethics refers to a code of conduct whereby it then aligns the obligations, how a person should behave in a professional environment, and takes into account that people may be coming from different moral cultures, different societies, different social and social as well as political or religious backgrounds. And the purpose then is to align the expectation of how people need to conduct themselves. And what IFAC have done is they've developed these auditing standards, they've developed the code of ethics, and then it's up to individual jurisdictions to then mandate these codes for their different members. So in Namibia, for example, ICANN, what they do is they dropped the code of ethics. In South Africa, we've got the South African South African Institute of Professional Accountants, SAIPA. We've got SAICA, the South African Institute of Chartered Accountants. They are all members of IFAC. And one of the requirements of being a member is that you need to adopt their codes. And then we also then have regulators like the PAAB in Namibia. In South Africa, we've got the RBA. In Mauritius, there are also, I forget the body's name over there, but these organizations then undertake and list the standards and adopt standards that then need to be applied in their jurisdiction, with sometimes blanket adoption, no changes, adopt the international standard. Other times they adopt the standard, but may make additional changes, additional requirements. And that is what, for example, has happened in South Africa. Another country that often does this is the UK. South Africa don't often do this in terms of the auditing standards, but from the ethics standards, this is something that has happened. And that's why we'll be looking at, from a South African perspective, just also understanding what some of those changes are. So when it comes then to the RBA code, and this is applicable to the International Ethics Standards Board for Accountants, the Code of Ethics for Professional Accountants. So there were concerns around the old code, and therefore the structure of the code was difficult to follow. It was uncertain as to, well, when do you need to apply, and independence provisions in particular. There was also concerns about safeguards. What is a safeguard? When can a safeguard be utilized? Is it applicable under all circumstances? How can it be utilized? When can it not be? In the previous auditing standards and code of ethics, there was very little reference to professional skepticism. And what we now have is significant improvements around professional skepticism and the application of professional skepticism and professional judgment, and how that needs to be applied in different scenarios to ensure that one is behaving in an ethical manner. And then other concerns were around what is allowed in terms of inducements. Previously, the inducement section was very restricted, mainly dealing with gifts. That has been significantly enhanced. And then from a South African perspective, because of the local South African nuances, the Independent Regulatory Board, RBA, then included certain amendments to the code. And for those of you that are from an international perspective, I'll be clarifying those and making sure that it's you'll see they're quite apparent, even the way these are numbered when we go through them, just so that you understand that this is something from a South African perspective that if you're from an international perspective, you don't need to worry about. From the point of view of corporates, I think that a lot of countries still have an audit requirement, and twofold. One, from a understanding of professional skepticism and professional judgment that is applicable to all professional accountants. However, when it comes to some of the inducements, well, that may have application for you in terms of the conduct with your auditors or with other professional accountants, but mainly the independent standards focusing more on the assurance space. So it would then govern how you would need to interact with professional accountants in public practice that are giving you assurance. Right. So when it comes then to some of these changes, so the code, the IFAC code or the URBA code, was completely rewritten some 3 years ago, and the purpose was to use new structures and drafting conventions to make the code easier to navigate, easier to use, and also very importantly from regulators and with the accountability and holding people responsible, ensuring that the code can be properly enforced. So the code incorporates several substantive additions and revisions, and that is a more prominently and enhanced conceptual framework. There's also provisions pertaining to safeguards that better align to threats, so that one can then see how then one can evaluate threats based on the fundamental principles as well as the independent standards, and then a focus on strengthened independence provisions, including provisions addressing long association of audit personnel with an audit or assurance client. There's also strengthened provisions for offering and acceptance of inducements, including gifts and hospitality, and then improved application material to emphasize the importance of understanding the scenarios when professional judgment is being applied. And then finally, application material, which then looks at how compliance with the fundamental principles supports the exercise of professional skepticism in an audit or other assurance engagement. So when it comes to the structure of the new code, so part one, that's the previously part A of the code, which deals with the fundamental principles and the conceptual framework, effectively how one then goes about applying one's mind, dealing with ethical challenges, and how then one needs to incorporate the requirements of the fundamental principles in one's practice or in corporate life, if that's where you operate. That's applicable. Part one is applicable to both professional accountants in public practice as well as those in business. Part two deals with professional accountants in business, and the purpose thereof is just to ensure that professional accountants, when they are carrying out services, that they conduct themselves in an appropriate manner and adhere to the fundamental principles. The purpose thereof is to ensure that no matter what business relationship or role one finds oneself in, there is a clear guidance, and the purpose of the code is that when the professional accountants in business are engaging with those that are also providing assurance to them, that there's a clear understanding of those relationships, what their roles are, whether they be as a contractor, employee, or owner, and how they need to then relate with their business and personal relationships and functions outside of the firm in terms of confidentiality, etc. From the perspective then of part three, that refers to the registered auditors performing professional services, and that includes audit and review. And their significant guidance because of the importance of independence when one is giving assurance, and that perceived level of lack of independence when certain services are offered. And then the independence requirements now sitting in a separate independence standards, excuse me, which are now part of Part 4A and 4B. Part 4A deals with professional accountants that perform audits or reviews. And then Part 4B deals with the independence requirements for professional accountants that do other assurance services. So I'm just going to go back a couple of slides. So effectively, the independence standards actually affect those people that actually are responsible for services under the IAASB, the International Audit and Assurances Board, and therefore that includes matters such as assurance independent review, or if you're doing the use of assurance, other assurance engagements, ISAE 3000 engagements, attorney trusts, that's the standard they're looking at for looking at assuring sustainability, etc. So that's the focus and applicability of the different sections. I don't know if there's any questions in that before we go on. Okay, so then from a international perspective, the IFAC code or the IRBA code are identical in that the code contains certain sections which focus on specific projects. Some sections contain subsections with specific aspects to deal with those topics, and each section of the code is structured in the following manner. There's generally an introduction which sets out the subject matter addressed within that section, and then by way of a R, by the section number, the subsection, the paragraph reference, it sets out the requirements that need to be enforced by the respective professional accountants in whatever jurisdiction they operate. That takes the introductory material, explains the use of the terms, how it needs to be applied to give a practical understanding of the different sections. The requirements then establish the specific obligations that need to be carried out by the professional accountants in the different roles that they may play. And then to give further clarification as to how those requirements are applied in different scenarios, there's application guidance or application material, which then clarifies the context, provides explanations and suggestions for actions or matters to consider, and sometimes illustrations and other guidance to assist professional accountants in complying with those requirements. So the effective date, so I'm just going to load this entire slide. So the effective date, the standard has been in place and effective in countries all over the world for some time. But different sections of the code applied at different dates. Parts 1 and 3, so that's the general principles, and those applicable to auditors were for audits on or after 15 June. Parts 4A and B, those are those assurance standards. Those are for periods beginning on or after 15 June 2019, and then the long association provisions for periods beginning on or after 14 December 2018. So as you can see, these have been around for some time. But I think it's always good to just have a refresher on them. In terms of then independence and the independence standards, so I'm going to show you just a short video clip just to understand what's changed in a bit more detail. Please, if you can just let me know in the chat or raise your hands or something if you're unable to hear the sound, but hopefully we've addressed that issue. I did activate the necessary sharing option, so hopefully this runs smoothly. Please let me know if you can hear it. Okay.
From a content perspective, the new code includes significant revisions and effectively packages all of the advances in the standards that have come about over the last 4 or so years. Something that definitely added to the complexity of the process was that while restructuring was going on, a number of significant sections were either being created or changed at the same time. This required careful coordination by the IASBA. Within the code, there were significant changes made to the conceptual framework, positioning it much more prominently, recognizing its significant importance in terms of ethical decision-making by professional accountants. And the code also includes enhanced safeguard provisions that better define what safeguards are and more closely match safeguards with the threats to compliance with the fundamental principles. 2 recently issued standards, NOCLAR, which lays out the framework for what professional accountants should do if they become aware of non-compliance with laws and regulations by their employer or a client, has been restructured into the new code. Likewise, the independence requirements around long association of auditors and their clients has also been restructured. We'll be spending some time today discussing these 2 standards. Another new standard regarding situations where inducements are offered to or by a professional accountant coincide with the June 15th effective date of the restructured code. Next, there are new and revised requirements specific to professional accountants in business, including new considerations when preparing or presenting information and requirements to follow when facing pressure to breach the fundamental principles. Another reason was to add clear guidance for professional accountants in public practice to be aware that some of the provisions for the professional accountant in business also apply to practitioners as it relates to their roles within their firms. And finally, the new code provides clearer guidance on the importance of understanding facts and circumstances when exercising professional judgment, as well as new application material to explain how compliance with the fundamental principles support the exercise of professional skepticism in assurance engagements.
Right. Sorry, there was no video with that. It's just a person speaking, and the lady's actually gone to the background. So thanks. There was no error there, but thanks for your comments in the chat. And I've got another slide which will be very similar.
From a
So in terms of then understanding the enhanced conceptual framework, let's then understand then what are the fundamental principles and how does this fit together and what do we need to focus on. So the enhanced conceptual framework is structured in that we have an overriding fundamental principles that need to be applied, and they are professional competence and due care, integrity, objectivity, confidentiality, professional behavior, and then independence, which is now sitting in parts 4A and 4B of the independence standards. In terms of integrity, so all professional accountants, no matter if you're in business or in public practice, have the responsibility to interact with their clients in a straightforward and honest way in all professional and business relationships, which means they need to be fair, truthful, honest in terms of their interactions. It's important that we realize that when the code then defines and says to professional accountants, well, what is your responsibilities? It introduces those with shall. So a requirement in terms of the code is shall. For example, a professional accountant shall not knowingly be associated with information where the professional accountant or auditor believes that the information contains materially false or misleading statements. And what's important to realize is that if you are aware, or you ought to be aware, well, then you need to disassociate yourself with that information. The professional accountant also needs to make sure that the information that they're associated with contains statements or information that is not provided recklessly. If it is, they would be guilty of an offense in terms of the code. And then they need to make sure that they do not omit or obscure required information. When it comes to the point of view of omission, I think we need to be very, take cognizance of this and be very alert to this, because what we're saying is that if information is portrayed and presented in such a way and other information is left out, well, if that information is critical to the understanding, well, then the principle of integrity would be undermined. The auditor needs to make sure that they then carry out their responsibilities, and so does a professional accountant in business, and comply with these requirements. When it comes to objectivity, so objectivity, a registered auditor or professional accountant needs to comply with the principles of objectivity, which require them to make sure that they do not compromise their professional judgment because of bias, conflict, or any undue influence. They need to make sure that they do not undertake any activity or expose themselves to circumstances or relationships that unduly influence their professional judgment regarding any activity which they would be involved in. When it comes to professional competence and due care, and I always say that this is, to me, almost the overriding one, because of its broad impact on the other principles. And that is that they need to obtain and maintain professional knowledge and skill at the level required for the services that they are offering. You know, and I'm saying, well, you can't know what's been left out or what should be included to comply with integrity if you don't know what your responsibilities are. A person needs to act diligently and in accordance with the applicable technical and professional standards that would include all standards that have been adopted by the professional body to which you belong, and those working in a professional capacity under an auditor's authority, that they have the necessary training and supervision, and those working in a professional environment need to also make sure that they have the necessary skills to perform the roles that they're engaged with, and that then you're competent to perform the engagement. If one has a challenge, a risk on any of these, well, then clearly one would need to then make sure that one disassociates oneself from such engagements. When it comes to confidentiality, so a registered auditor or professional accountant needs to comply with the principle of confidentiality to respect the source of which the information has come from as a result of their professional or business relationships. The confidentiality of information extends to within the audit firm or corporate, and needs to make sure that they do not utilize that for to gain any personal advantage. A person needs to be alert for the possibility of inadvertent disclosure in social settings where one's guard may not be at as high as necessary. This could be social, could be family, etc. The person needs to maintain confidentiality, and that information needs to be retained and cannot be disclosed to prospective clients, other than very, I've seen some firms actually request just to include the client's name sometimes, that, this is who we operate for, but I don't think that's anything confidential. And the requirements of confidentiality cannot be breached or overridden unless there is legal or professional duty to disclose. In terms of when changing employment, so it's important to realize that the confidentiality extends even after the direct relationship, employment relationship, or contractual relationship in an audit client scenario, so that relationship continues. And it's important to realize that confidentiality serves the public interest because it facilitates the free flow of information between professional accountants and third parties. However, we need to be aware that confidentiality is not at the same level as in the legal fraternity, and that professional accountants might have an obligation to disclose confidential information when such disclosure would be appropriate, and that could be if it's required by law, for example, in terms of legal proceedings, or it could be needed by the public authorities if there have been any infringements on particular legislation. That would include disclosures such as reportable irregularities or material irregularities, as they are in some other international laws. And then obviously disclosure would be permitted if authorized by a client, and the ultimate override is where there is this non-compliance with laws and regulations, and particularly where there is potential substantial harm that could have been perpetrated. When it comes to professional behavior, so a professional accountant needs to avoid conduct that the auditor knows or professional accountant knows might discredit the profession. They need to make sure that they engage in business, occupation, or activities that do not impair or be alert for the possibility where this may impair the integrity or objectivity or the reputation of the profession, or may result in a potential conflict with any of the fundamental principles. When it comes to the changes to the independence standards, so the revised international independence standards, we've said part 4A deals with audit and review, and part 4 deals with the provision of assurance if you're doing other related assurance engagements, like audit of attorney trusts, audit of estate agents, anything under ISA 3000, your review engagements are covered by 4A. So there's no real differences other than the differences that apply from a public interest perspective. So when it comes to independence, a professional accountant needs to apply professional skepticism, because there are two primary aspects of independence. There is independence of mind, which is that state of mind that allows the auditor or reviewer to express a conclusion without being affected by influences that would compromise their judgment, thereby allowing them to act with integrity, exercise of objectivity, and professional skepticism. And then there's the independence in appearance, and that is that in addition to being factually independent, the independence of mind, one needs to be independent to avoid facts or circumstances that may be deemed so significant that a reasonable and informed third party would likely conclude that a firm or an audit or assurance team member's integrity, objectivity, or professional skepticism has been compromised. So when it comes to independence in mind, we're saying one needs to act, making sure that one is not influenced and any individual acts are carried out with integrity, objectivity, and the new requirement being professional skepticism. The harder hurdle is to deal with independence in appearance, and that is, what would somebody else think of my actions? Some of the cases are pretty obvious in terms of having shares in a client, having a loan with a client, and then auditing that entity. But sometimes it becomes a bit more gray, less easy to understand. And that's where the code has significant, and the independence standard have significant guidance to try and give a deeper understanding on how the principles of integrity, objectivity, and professional skepticism need to be applied to ensure that a reasonable and informed third party would conclude that the principles of the code have been adhered to. You know, it's interesting when one looks at the requirements of the code and all standards coming out of IFAC are principles based. One then needs to look at one's actions to determine, well, is this the way in which we are behaving appropriate, or is one just looking for an out, or to see, is there a rule? If there's no rule, well, what is the intention of the code, and how then should one conduct oneself? And I think that's the ultimate purpose of making sure that when one applies the code, one does it in a responsible manner. So while professional skepticism is an attitude, this attitude is applied in making professional judgments. And those professional judgments form the basis of the actions of a professional accountant. And what's then very important is the documentation of professional judgment, how one has applied one's mind, the actions that one then takes, and then the evidence that one retains as to how one has considered different possibilities and arrived at the course of action to demonstrate that the action was appropriate and ethical. So how then do we then adopt an attitude then of professional skepticism? So in terms of professional skepticism, so professional skepticism is defined as an attitude that includes a questioning mind, being alert for conditions which may indicate possible misstatement or errors, or that there has been a lack of compliance with the information in terms of any of the fundamental principles. And it's important to understand that this definition on your screen comes from one of the international standards on auditing, ISA 200. And there's therefore a explicit requirement on auditors, more so than on professional accountants in business, that they need to adopt a enhanced level of professional skepticism because of the role that they have and the responsibilities and the reliance on the information and the association of their name with underlying financial statements or reports. And although the definition of professional skepticism of some may differ with some national standard setters, the IAASB has prescribed it to try and align the requirements and understanding of what a person's roles and responsibilities would be. So when it comes to the code and professional skepticism, the code has included significant, and this is the URBA code or the IFAC code, have included significant application of how compliance with the fundamental principles supports the exercise of professional skepticism, and particularly in the context of audit reviews and other assurance engagements. So when performing an engagement, the professional accountant and auditors are required to exercise professional skepticism when planning and performing the services that they exercise. An auditor, obviously, audit reviews or other assurance engagements. If you're in business, well, whatever services you provide to your corporate would need to then, you would need to make sure that they are then applied in terms of the principles. And then professional skepticism and the fundamental principles are described in section 110, and they are interrelated concepts. In other words, even though we define them separately, you have a requirement of objectivity, you have a requirement of confidentiality, you have a requirement of integrity. We need to realize that, well, when applying confidentiality, you need to be honest and objective in the way in which you evaluate the services and the type of services and the work that you carry out. So we're heading on to nearly 10 o'clock. So I think before we go into some of the application of the concepts of professional judgment and professional skepticism to the different fundamental principles, I think here's a nice chance to break for 5 minutes. So if you can just have a leg stretch, I'll make it nearly 10 o'clock, so we'll be starting at just after 10. So if we can just synchronize your watches, we'll be back in 5 minutes. Thanks a lot. See you shortly. Right, we'll be starting shortly. So if you can just get ready. Right, so welcome back. Then in terms of understanding, then how do we then apply professional skepticism? The code provides the following examples in terms of applying the fundamental principles individually and collectively, and how that would be applied in the context of integrity. So a auditor or professional accountant needs to be straightforward and honest in terms of all their dealings, and being straightforward and honest would then mean that they would then need to make sure that where there are potential concerns about a particular position taken by a client, that is appropriately raised. If you're in a corporate environment, you know, if management are preparing a particular accounting provision, you know, have they taken into account all the information? Are they biased in sort of in trying to achieve a desired outcome? Have they considered any other inconsistent information? Has there been an understanding of the methodologies, the tools utilized? Are those tools still appropriate? Is there any course of action which has been ignored, or potentially alternatives not considered, because then maybe one's omitting something? And therefore one needs to address these matters in a holistic and robust perspective, so that one can demonstrate a critical assessment of the information to make sure that there is evidence of the contribution of professional judgment and the application of professional skepticism to the different circumstances. When it comes to objectivity, so the code says that a professional accountant needs to look at the principles individually and collectively, and one needs to look at, well, based on one's dealings, are there any circumstances which may give rise to a potential bias or conflict of interest? For example, we're going to be touching on it: inducements, gifts, hospitality. We know what happened with the Gupta wedding, as an example. And then one needs to look at recognizing circumstances or relationships and focusing on threats such as familiarity with a client. You know, yes, there is a requirement for auditor rotation, but that's only in statutory audits. That does not mean that there's no familiarity threat which could impair objectivity with an entity that's not a statutory audit from a South African perspective, or from an international perspective in terms of the a public interest entity. which then one would need to rotate every 7 years. But I've seen situations where, as a result of this familiarity threat, certain firms are rotating all their clients where they do assurance work because of the perceived threat on the auditor's professional or business judgment. When it comes to competence and due care, so I would hope many of you in South Africa are aware that the requirements for CPD have changed for your continued professional development, and that it's now no longer sufficient to just have 120 hours over 3 years with 9 hours in ethics on this rolling 3-year rolling basis. One needs to make sure that one looks at the services that one offers, and one needs to develop a CPD plan which would then focus on the areas and changes that are happening in the services that you provide to make sure that you have the necessary skills and knowledge and are able to act diligently. And that would be applicable to your clients, to their industries, to the range of services you offer. And therefore, it's important to properly identify areas where that could be compromised. And then, from the perspective of an auditor, the auditor would need to make sure that they're aware of the changes in their client's industry to properly address or identify any risks and then respond appropriately. And then also in terms of developing responses to those risks so that they could then ensure that there is a mitigation of that risk. And that is the level of competence and professional care that is required. Skepticism is a process of applying reason and critical thinking to determine the validity of information. And a skeptic needs to make sure that they critically evaluate information to obtain support for the conclusion, but they need to be alert that they can't be just justifying preconceived beliefs or understandings of the information. And therefore, one needs to get a balance between being a skeptic versus a cynic, whereby a cynic is inflexible and will distrust most information. A skeptic will evaluate all information, will verify information, particularly in areas which they believe is telling the true or fair picture, and then based on the evidence obtained will then objectively conclude whether or not the information is as it is purported to say. One needs to be aware that time pressure has a significant ability to inhibit the application of skepticism, and therefore one must ensure that one develops and plans appropriate time to carry out one's professional duties, because otherwise the fundamental principles will be compromised. And as we've said, when it comes to education and being up to date, that has a critical impact, because you can't look at alternatives, you can't evaluate information if you don't know what is the requirements from a legislation or a regulation or professional standards perspective. Don't know if there's any questions before we just look at a brief example. So I think when it comes to the application of professional skepticism, we as professional accountants are being asked to ensure that we play devil's advocate, not concluding and looking at information based on preconceived ideas. We need to make sure that we consider, what if the assumptions were reversed? How would we be able to argue? What evidence would we need? One also needs to look at contradictory viewpoints. Looking at information that does not support the conclusion or the information, and how then do we evaluate that and take that into account, and do we need to then change our viewpoint, or is there a rational, logical explanation which then can be utilized to support why the contradictory viewpoints are not applicable, and that a reasonable and informed third party would agree with that assessment. From the South African perspective, the International Code of Ethics has had certain enhancements, and these enhancements are clearly delineated by a SA reference after the requirement. So in South Africa, there is a requirement that has been added to the code, and the enhancement deals with professional competence and due care. And because of the current disciplinary processes that have been taking place as a result of investigations and, let's say, delinquent auditors, the regulator has included certain additional requirements, and one of those requirements is that a registered auditor is not allowed to undertake an engagement where competence is lacking, because this then becomes a breach then of the code, unless the auditor obtains advice and assistance to carry out the engagement satisfactorily. And I think it's important that we realize at what stage that advice and assistance needs to be. I've been involved in some of my clients recently looking to get accredited for the assurance of specific industries where there is a regulator that's appointed by the Financial Reporting Conduct Authority. And what's interesting is that before the appointment can even take place as auditor, the regulator needs full disclosure of who they're looking to utilize and what experience the auditor has. And, you know, this is the way in which the audit regulator is moving, is to say, well, it's all very well saying you're going to go and audit a bank, but do you have the knowledge of Basel requirements, of the information coming out of the banking association? Are you familiar with the additional reporting requirements from the Reserve Bank? It's unprofessional to say, well, I'm going to sign the client and then get the resources. And that's what the regulator, from a South African perspective, is codifying by this amendment. When it comes to being associated with multiple firms, so from a codes perspective, there is a requirement that a registered auditor is allowed to be associated with more than one firm. So you can sign off audit reports in different firms. However, what is being clarified is that such association needs to be clearly explained, must not be misleading or cause confusion, and the registered auditor needs to ensure that there's a clear distinction between the different firms. If a person has a designation other than an auditor, well, they are then not allowed to be describe themselves as auditors. There's been numerous situations whereby associates of firms have been found guilty in terms of the code of, in terms of having signed off assurance engagement related work without having the necessary authority. And what's important is, and sometimes even practitioners, would you believe it, assisting associates to hold out to purport that they are actually auditors. Sometimes a scenario where a person was not practicing as a registered auditor and allowed the use of their audit practice number to somebody else who didn't have the qualifications, and this person was signing off. And my understanding is the person was found guilty of breaching the code for these requirements. But I think these changes to make it a lot more easier to enforce that this is a clear breach of a particular section. With regard to the signing convention for reports, so a registered auditor is not allowed to delegate the authority to any other registered auditor or to somebody who is a non-registered auditor unless there is an emergency situation with sufficient gravity, and then that other party can only sign if two requirements are met. The first is that the client is fully informed, and this means that the client needs to be fully informed prior to this taking place. And very importantly, the regulatory board needs to give written consent for such delegation, and that needs to be obtained prior to the action taking place. So it's important that we are aware of this, and that if these emergency situations do arise, one would need to then make sure that this is appropriately dealt with. When it comes to the signing conventions, in an audit or review or other assurance engagement, the registered auditor's name must be included. This should be a change. One is allowed to utilize the initials. No longer is there a requirement to utilize the full name. The capacity in which they're signing, is that as a director, sole proprietor or something, a partner, the designation registered auditor, and then if that has not been included on the firm's letterhead, then the name of the firm that is signing that would also need to, or the name of the firm that the auditor is registered with would also need to be included. I don't know if there's any questions on any of this information so far. Okay, so then moving along, when it comes then to further enhancements from a South African perspective, what they've done is they've taken what was previously guidance and elevated this to actual a requirement. And that is, there is now additional responsibilities placed on a South African auditor, whereby if a proposed, if there is a change in auditors or accountants, particularly in the audit environment, there needs to be engagement with the predecessor auditor or accountant, and the purpose of that proposed engagement is to understand whether or not there are reasons professionally that the person should not be engaging, the professional auditor or accountant should not be engaging with that client. And if the client refuses or fails to give permission, well, then the practitioner, unless there are exceptional circumstances, needs to decline the engagement. So that is quite a significant and onerous responsibility, and therefore I think this stems from very, how can I call it, entities which had very dubious motivations and ethical practices, and then other firms taking on those roles without carrying out the necessary requirements and responsibilities to investigate. The proposed accountant needs to communicate and then they need to decline unless those exceptional circumstances are met, and they have full knowledge of the requirements and they are satisfied regarding the relevant facts by other means. And I think it's that last principle that becomes very difficult to achieve, because, you know, so if the information is available in the public, well and good. But if the client is trying to hide something and refuses to obtain this, refuses to allow the professional accountant to communicate with the outgoing professional accountant or auditor, well, then we have a particular scope limitation in terms of accepting the engagement. and where there is confidential information that has been obtained, that would then need to be treated appropriately, cannot be disclosed other than in accordance with the principles of non-compliance with laws and regulations, or if there's any other aspects from a legislation to disclose that. With regard to the enhancements around contingent fees, so an auditor is not allowed to charge contingent fees for the preparation of tax work, being the completion of tax return or the amendment of a tax return. So to object and based on certain work, charge a percentage of the saving that's going to be achieved. And the reason that this has been prohibited is because this creates a self-interest threat to objectivity, which cannot be eliminated, and therefore, because it cannot be eliminated, even with the utilization of safeguards, because they would be ineffective under the circumstances, so therefore such a requirement would then not be allowed in South Africa. Don't know if there's any questions. From an international perspective, while it's not as restrictive, there's no specific requirement. I think the principles would need to be applied and assessed before one takes on any work, particularly in the tax area. When it comes to custody of client assets, so a registered auditor is precluded from holding client assets that are derived from illegal activities, and therefore a person needs to carry out, if they are receiving funds, significant amounts, they would then need to get an understanding from a FICA perspective as to how these funds have been derived, and any monies held, the practitioner, auditor, or professional accountant needs to make sure that they are not describing these as being held in trust or in a trust account, because that is a separate legislation that governs that, that's applicable to in terms of the legal practices. And where they are holding client funds, they need to be totally separate from the registered auditor's bank accounts. There needs to be appropriate designation of the funds. Any funds received would need to be deposited without delay. And there would need to be, if they are running this for numerous different clients, particularly then detailed accounting records. There would need to be reconciliations performed between the funds received and the different clients, and these funds should be held for a limited period of time only. Important requirement coming through from the South African perspective. Where there's the holding of client assets other than money, well, similar requirements. These amounts cannot be referred to as being held in trust or in a trust account. There needs to be adequate and reasonable identification of and maintenance of those accounting records. And then there needs to be proper safeguards to ensure that these client assets are protected, so that not only will they not be potentially damaged or lost, but also need to be safeguarded from unauthorized use as well, no matter what source they, sort of what nature they are. Could be share certificates, title deeds, anything such as those. In terms of additional measures for protection for client assets, appropriate measures include where there is a large number of clients and an umbrella account is being run. The umbrella account needs to have sub-accounts, so some sort of listing of deposits and the different clients to which that would relate. Where funds are held for a long period of time and the RA is not the assurance provider or auditor, there the registered auditor should request the client to open a separate bank account, and the RA should then be given power of attorney or signatory rights over that account, rather than that being administered in a umbrella fund with, if it's going to be for a longer period of time, because we said they can only hold that for short periods. And then from a professional care point of view, registered auditors carrying out such services are required to ensure prior to taking custody that they have the necessary indemnity or fidelity cover, or assess that and ensure that that is increased if necessary. And then there should be a letter of engagement that is drawn up explaining the risks and making sure that the client is aware of that and has agreed to those to the circumstances and are fully aware of the risks that they may be exposing themselves to. With regard to the custody of client assets for audit and assurance clients, so we've said that unless one can focus on those risks that we've looked at and reduce them to an acceptable level, if the RA has got funds, then they would be prohibited from accepting the client unless these requirements can be eliminated, these independence threats can be eliminated or reduced to an acceptable level. And if the auditor partner is in a practice, well, the firm or network, if they are carrying out these sort of custody of assets, well, we need to make sure that they do not take management responsibility for these assets, and they would need to be for a short period of time. And if they're doing other assurance requirements, cannot relate to the subject matter. So, you know, you can't ask them to, a client can't ask an audit firm to hold funds, and then they're in the middle of auditing a valuation or something, or a business acquisition or something, and these funds are then going to be paid over as a result of the work that they then carry out. So before we look at the dealing with ethical challenges and the way in which one applies one's mind in that regard, how one demonstrates professional judgment, are there any questions? Okay. So then when it comes to dealing with ethical challenges, so the code has a framework in which it needs to be, challenges need to be addressed. And overarching that is the exercise of professional judgment. One needs to be professionally skeptic, being alert for information and changes in facts and circumstances. And then one needs to also take a step back approach and apply the reasonable and informed third party. Those are the overarching principles around dealing with ethical challenges. But the way in which one actually goes about identifying and evaluating and addressing the threats then becomes critical. And that's what we're going to be focusing on now, to understand how then one looks at professional skepticism and judgment in making a professional decision. And while professional skepticism is the attitude, what we're looking at now is how do you apply professional skepticism in making a professional judgment. So we've been speaking about professional skepticism and judgment, and the concept of professional skepticism and judgment are closely related. Professional judgment will often facilitate the appropriate exercise of, or should I say, professional skepticism, sorry, will often facilitate the appropriate exercise of professional judgment. Similarly, the application of professional skepticism requires professional judgment, and therefore both concepts are essential in making a decision to ensure compliance with the fundamental principles. And what one needs to do is one needs to understand from these two perspectives what has transpired, where has it transpired, who's involved, when did it take place, what is the business rationale for these transactions, and how have the transactions been recorded, how has the transaction been entered into, how does one deal with these requirements. So let's then look at these three stages to the conceptual framework. And the way in which one evaluates a potential threat, sorry, the way in which one evaluates potential breach is one identifies the threat to compliance with any of the fundamental principles. One needs to understand which principle is being questioned or challenged. Once one's identified that and identified the information and the surrounding, gained a sufficient understanding of that, one then evaluates the threats identified, including being alert for the requirement to be on the lookout for new threats as the process evaluates, as the process unfolds. And then one has a responsibility to address that threat, including in the new requirement of the step-back approach to review the overall conclusion about whether or not the threats have been appropriately addressed. So the overarching requirement then is that when applying the conceptual framework, a person is required to exercise professional judgment, remain alert for new information and to changes of any facts or circumstances, and then apply the reasonable and informed third-party test, which we'll be discussing just now. We've been speaking a lot about professional skepticism, so let's understand professional judgment and how that needs to be applied. And professional judgment is the application of relevant training, one's professional knowledge, skill, and experience, which is commensurate with the facts and circumstances, including the nature and scope of the professional activities that are being undertaken, and incorporating the interests and relationships involved. The IESBA, in the development of the new code, has considered whether a new specific requirement needed to be included for auditors, and the IRBA code went one step further and said because of the particular circumstances in South Africa, additional requirements were included in this regard from a South African perspective as well. So when it comes then to identifying the threat, so one needs to then obtain sufficient understanding of the facts to gain a better objective of which potential principles could be at risk. And one would then need to take into account known information, as well as if information is not making sense or is contradictory, applying that level of professional skepticism to ensure that one then obtains all the necessary information. In terms of obtaining an understanding, the professional accountant needs to look at and have a clear understanding of, when applying professional judgments and understanding the circumstances of the potential threats, on what basis is there reason to be concerned that potentially relevant information might be missing? There may be facts or circumstances that the professional accountant is aware of. There also needs to be consideration of an inconsistency between known information and expectations. And if, for example, one is expecting a certain outcome, for example, based on the economy, based on COVID, based on the impact of COVID on that entity's environment, their industry, etc., and the results are showing a different picture, well, one would need to make sure that one then assesses that information in more detail. This needs to be commensurate with the person's expertise and experience, but remember, one needs to make sure that one's only undertaking engagements where one has the necessary skills and expertise. Part of obtaining that understanding to identify a potential threat is, does one need to consult further? I've got a forensic accountant that I often deal with. I've acted as an audit expert for them, and got a call yesterday on something that he was dealing with, where he was trying to understand the information a bit more to see whether or not he had any potential conflicts. Did he have a sufficient understanding of the nature and circumstances of the transaction and the way in which it needed to be treated. The information needs to then be evaluated to make sure that it provides a reasonable basis upon which a conclusion can be reached. And then the auditors or registered professional accountants' own preconception or bias needs to be considered to determine whether or not this may be having an impact on the potential understanding of the transaction. And then one also needs to just be alert for other possibilities, the application of professional skepticism as to, well, this is the answer I want, but is this the correct answer under the circumstances based on the scenario, based on the information? Management would then have a responsibility to make sure that they carry out their responsibilities and that they facilitate the adequate provision of information. They would need to lead and direct the entity, including in making decisions regarding the acquisition, deployment, and control of the various resources, be that human, technological, intangible, etc. And it's important that when obtaining an understanding of the transaction, you understand what management's responsibility was, what their involvement was, and very importantly, that the auditor isn't compromising in terms of and isn't compromised in the exercise of their roles. Examples where professional accountants may have put their auditors in a situation which could have breached their confidentiality would be as where the auditors have been involved in setting policies or strategic direction. The hiring or firing of employees, it's a professional accountant, an auditor in particular, is not allowed to hire or be involved in the HR process of a client, because if they were employing a financial director, financial manager, well, that would then take on, that would put them in a position of compromising their ethical responsibility. The auditors and reviewers are not allowed to direct or take responsibility for actions of employees. So an employee of your client cannot report to yourself. Not allowed to authorize transactions. Cannot control or manage the financial resources of the entity. Cannot have control over the implementation of firm or third-party recommendations, because once again, that then is extending one's responsibilities and taking on a management role. The accountant or cannot have responsibility, the auditor cannot have reporting responsibilities to those charged with governance on behalf of management, cannot prepare financial statements or design or implement or maintain any internal controls of the entity. With regard then to the reasonable and informed third-party test, so this is a new requirement in the code, in the new code, and what this requirement does is it mandates the professional accountant to take a step back to evaluate whether or not the conclusions that they have reached would likely be reached by another party, taking into account all facts and circumstances, be they known or information that could reasonably have been obtained, and therefore the person would have been expected to know that, and at the same time that the conclusion was made. So obviously, not looking at hindsight, based on that, does the reasonable and informed third party also possess the relevant knowledge and experience, and has the person then been able to exercise their professional judgment in an impartial manner so that somebody else would arrive at the same conclusion. Examples of the reasonable and informed third party test, whereby one assesses the information, for example, implying a conceptual framework. Has there been consideration of the conclusion that the framework is appropriate to the entity? When it comes to addressing a threat, the informed reasonable third party test at that level would say, well, what is the threat? What are the, based on the understanding, which of the fundamental principles are in question? And has that objectively been reduced to an acceptable level? And then when it comes to independence, that the professional accountant appears to be independent, that level of independence from a parent's perspective. So I think now when it comes to addressing the threat, that'll take us to the prompt action as how does one address the threat? And I think this is an appropriate time to break for a tea break. So if I can give you 15 minutes, so it's just gone 5:02. So if we can be back at 10 past, and then we'll be continuing with the final session. Okay, enjoy your break. Thanks, see you in 15 minutes. Right, we'll be starting in a couple of minutes, in about a minute or so. Right, welcome back, everyone. So let's now have a look at how then we address threats. So in terms of the responsibilities and the ability to address a threat, there are three alternatives. Either the circumstances can be eliminated, including the threat or the interest or the relationship that's creating the threat, or a safeguard could be applied when available, which is capable of mitigating or reducing that threat to an acceptable level, or one would need to decline or end the specific professional activities. So when it comes to eliminating the circumstances, so one could, for example, sell shares in an entity that reduces the potential conflict. Applying a safeguard, we'll understand that in a bit more detail, because not all the time will a safeguard reduce a risk to an acceptable level, particularly where one's dealing with public interest entities. And one could potentially decline or end a relationship if there is no alternatives. Well, that would then be the only possible alternative if one's facing a situation where one's unable to get around or reduce a risk to an acceptable level. So, as we said, and was brought out in that short video, one of the significant changes is the application of and additional guidance around safeguards. And the ISBA sought to clarify the safeguards that were perceived and uncleared, and to clarify where they are warranted, and eliminate safeguards where it's believed they would be inappropriate. And the purpose of the revisions to the safeguard was then to better correlate safeguards with specific risks or threats that they were intended to address. There also needs to be clarity on the application of safeguards, because not all safeguards, or sorry, not every threat has a safeguard that can be applied in its relevant circumstances. So, therefore, let's then understand what is a safeguard. When is it accepted? What is an acceptable safeguard? And what is the appropriateness and effectiveness? When is that adequate? So safeguards are actions which individually or in a combination will reduce a threat to compliance with a fundamental principle to an acceptable level. The leading question is, so what is an acceptable level? And that would be the level at which the auditor, using the reasonable and informed third-party test, which we discussed earlier, would likely conclude that the registrar or auditor has complied with the fundamental principles. And that's what's considered appropriate and effectiveness. So when it comes to significant judgments, one needs to ensure that the practitioner shall form an overall conclusion about whether the actions of the registered auditor takes or, sorry, that the registered auditor takes or intends to take, that they are appropriate to address a threat that will eliminate those threats or reduce them to an acceptable level. And then the registered auditor then should review any significant judgments made or conclusions reached. They would also need to then carry out the reasonable and informed third-party test to ensure that where they have made significant judgments, that a independent party would arrive at the same conclusion. With regard to the documentation, so it's important that there is an adequate record of the different stages, how professional skepticism is applied, what procedures were carried out in the identification and obtaining an understanding of the circumstances and the threats with any of which particular principles were at risk, and then the documentation of professional judgment, how one looked at the informed third-party test, how one evaluated that information, and then how one arrived at an appropriate conclusion. So all of those circumstances would need to be documented. With regards to the independence of a professional accountant in public practice, so those of you not in the audit environment, so I'm just going to show you a short video clip here of, once again, there's no moving, it's just somebody talking, so you'll just have audio, just with an understanding of some of the requirements that would be applicable to you in the carrying out of your professional duties. Okay, please just give me a thumbs up if you can hear that. If you can hear this, I'm going to play it now.
Part 4B, and here, as you see on the slide, the same information as it applies to Part 4B, which deals with independent standards, but for assurance engagement other than audits and reviews. This would include reports such as assurance on a company's system of internal control, or perhaps assurance on the company's statement on its greenhouse emissions. Next, we'll take a look at the strengthened provisions around long association between auditors and their clients.
Okay, so just a brief overview, sorry, of the independence requirements for those other than audit, and you can see gifts and hospitality, financial interest, loan guarantees, as well as long association and provision of non-assurance services to an assurance client. Those are all also part, and that's what we're now going to be looking at in a bit more detail. Remember, this also applies to the auditors, so let's then get on with the learning. So, as mentioned in the past, previously, the only inducements that were considered were gifts. But what is an inducement? And the code defines an inducement as an object, situation, or action which is a means to influence behavior, but not necessarily with the intent of improper influence. And it's that second sub-bullet we need to concentrate on, because what we're saying is, even if it's not to improperly influence, an inducement would still be against the code. It may just want to cement the relationship, but because there is a risk that this will lead to a lack of objectivity, inducements have been enhanced. And inducements include gifts. I think we all understand what that means. Hospitality, be that the latest sports event at your suite at the stadium when one will be allowed to go and watch sports properly again. Any forms of entertainment, political or charitable donations, appeals to friendship and loyalty, the offering of employment or other commercial opportunities. And it's interesting, you know, we don't need to look too far just with what's been happening in government and how we see how this has been abused in the parastatals that we've got. And then giving any preferential treatment, rights, or privileges would also be viewed as an inducement. And these inducements can take, be prohibited by law, or just in terms of common principles that they're not deemed to be desirable, that they aren't in good taste, and therefore a registered auditor is prohibited from accepting, or anybody providing any assurance is prohibited from accepting any sort of inducements from their clients, because this could impair their objectivity and improperly influence the behavior of a recipient or another individual. And it's important that when we look at it from the point of view of, even if the inducement is not going to the person providing the assurance, well, if it's going to the managing partner of a practice, well, I think we can understand the implications. And important to realize that an inducement is considered as improperly influencing an individual's behavior if it causes that individual to act in an unethical manner. Such improper influence can be directed either towards the recipient or towards another individual who has some relationship with the person that is given the inducement. The fundamental principles are an appropriate frame of reference for professional accountants and registered auditors in considering what constitutes unethical behavior on their part or on the part of the people with which they engage. And a breach of the fundamental principle of integrity would arise when the auditor or professional accountant accepts or encourages others to offer or accept an inducement where the intent is to improperly influence the behavior of the recipient or another individual. And the other application guidance just clarifies that the determination of whether there is actual or perceived intent to improperly influence behavior requires the exercise of professional judgment. Relevant factors to consider would include the nature, frequency, value, and cumulative effect of the inducement, the timing of when the inducement is offered relative to any action or decision that it might influence, whether the inducement is a customary or cultural practice in the circumstance, for example, offering a gift on the occasion of a religious holiday or wedding or something, or whether the inducement is an ancillary part of a professional service, for example, offering or accepting a lunch in connection with a business meeting. Other considerations, whether the offer or the inducement is limited to an individual recipient or available to a broader group. The broader group might be internal or external to the firm, such as suppliers to the client. The roles and positions of the individuals at the firm or the client offering or being offered the inducement, and the degree of transparency with which the inducement is offered. And finally, whether the inducement was required or requested by the recipient. So all of these factors then need to be incorporated to determine whether or not the inducement would be allowed. And this is from the application guidance in the code. I don't know if there's any questions before we move on to the long association requirements of the code. The final changes we're going to be addressing before we just do a short some practical examples. Right, can't see any hands going up. So then let's move on with the learning. So when it comes then to the long-term association provisions, so as previously discussed, this section of the code has been effective since 15 December 2018, and it deals with the long-term association personnel in an audit or assurance client, including partner and rotation with that audit client, and the primary focus is for those entities which are public interest entities. Now, if those of you in the corporate world are saying, well, we're not viewed as a public interest entity, well, I do think it's important that you're aware of this from the perspective of that not just listed entities are regarded as public interest entities. Significant entities need to be evaluated by auditors, and auditors, those of you in public practice, need to have an individual definition of what a public interest entity is from, I think it's the end of this year, in terms of the changes to the code around public interest entities. So that's why we're stressing this again. And therefore, if a person is an engagement partner from an international perspective, the time allowed on an audit would be a maximum of 7 years. From a South African perspective, for those of you who are registered with the RBA, we know we have requirements that restrict that to 5 years. And then from a cooling off perspective, well, a cooling off period now has increased to a 5-year period. Previously, that was set at 2 years. They were saying, no, that is an insufficient time. The engagement partner on a public interest entity would need to not be involved in the audit for a 5-year period. Individuals responsible for the external quality control reviews, once again, 7-year period from international requirements. No, I'm not aware of any countries that have got more restrictive requirements in that regard. And the EQCR reviewer now has got a cooling off period of 3 years. When it comes to other key audit partners, so this is somebody that is expressing an opinion on a significant portion or component of a set of consolidated financial statements, is part of a listed entity, or perhaps a division of that entity. Once again, a maximum of 7 years from an international codes perspective. If that division, for example, is not a separate company, so then there would be no separate or more restrictive requirements from a South African perspective, and their 2-year cooling off period would be required. Obviously, it would be very important to manage other key audit partners, their rotation requirements, because they may be eligible to be the engagement partners of certain clients, and therefore one would need to just sort of plan this well in advance. Where people performed various roles, so in where the engagement partner or practitioner served in more than one role. So if the engagement partner was a key audit partner as well as an engagement partner, well then the period in the combination of those roles, they would only be allowed to have a maximum of, if they were in that position for 4 more years, they would have to have a cooling off period once again of 5 consecutive years. I'm just going to go back a slide. So what we're saying is previously you had a 7-year requirement and 5-year and 2-year cooling off period. Now what we're saying, well, if they were in that role for 4 more years, so that would mean 4, 5, 6, or 7, well, they would then need to then cool off for the 5 years, that maximum. If they were the key audit partner and EQCR, well then, once again, for 4 more years, they would need to go to the maximum of the 3-year consecutive cooling off period for the EQCR. Then, if they were the engagement partner and EQCR for 4 more consecutive years, well, depends what role. If they were the engagement partner for less than 3 years, then they would have a 5-year, 5 consecutive years. Otherwise, if they any other combination, they would have 3 consecutive years of a cooling off period. Any other combination of key audit partner role, there would be 2 consecutive years. So when it comes to the long association provisions, if a key partner of an audit client was a person was in that position for 5 years or shorter, and then the entity became a public interest entity, so then the practitioner would be allowed to continue to serve for a maximum of 2 years, therefore 7 years less the period as key audit partner. And this is only on transition when an entity becomes a public interest entity. So you had a small or medium-sized client, they were not a public interest entity, and either they became part of a listed group or listed themselves, or you evaluated your client and determined that such a client should actually be regarded as a public interest entity. So if the person was a key audit partner for a period of 5 years or shorter, then they would only be allowed to be a maximum of 2 years under those circumstances, or what we're saying, if it was 4, then it would be for 3 years, etc. If, however, the person was a key audit partner for 6 or more years, they would only be allowed to continue for a maximum of 2 more years. So certain allowances because the change in status of a public interest entity. So there are then certain transitional provisions, but I think since the code has been in place for some time, I don't think it's necessary that we look at those in much detail, other than if you do have any questions, please be aware to look out for what those transitional period requirements are, because there are allowances for when the code becomes effective as to what's happened. If you hadn't, even if the entity was PIE. So that's what these transitional provisions deal with. So just to alert you to that, but there is certain additional relief depending on how the entity was classified and how many years the practitioner was enrolled. With regard to the Companies Act perspective, from a South African perspective, just a reminder once again that from the Companies Act, auditors required to rotate every 5 years. And from a quality control perspective, such rotation should be appropriately planned and documented so that it can be effectively managed. From the perspective of the cooling off periods, so it's important to understand what is allowed and what is not allowed in the cooling off period. And when it comes to the cooling off period, so an engagement team member or person who was responsible for as a key audit partner, etc., those people could be would not be allowed to carry out provision of quality control for that audit engagement. There's also a restriction on them consulting with the team or the client regarding technical or industry specific issues, transactions, or events affecting the assurance engagement. They would also not be allowed to lead or coordinate or oversee the relationship of professional services to that audit client. They would be allowed to provide non-assurance services, but that would be dependent on their frequent interaction with senior management or those charged with governance, and provided they're not exerting direct influence on the outcome of the audit engagement. However, the individual is not prevented from assuming a leadership role in the firm or network, such as that of senior or managing partner, just because they're on a cooling off period. Interesting. So, as we've said, a firm is required to determine their own public interest entities in addition to the requirements in the code that an entity which is listed on a recognized stock exchange is regarded as a public interest entity, and factors to consider whether to treat other entities as public interest entities are the nature of the business of the entity. Do they, for example, hold significant assets in a fiduciary capacity for a wide number of different stakeholders? What is the number of equity or debt holders? The actual size of the entity, be that by turnover or by employees or assets. And finally, the number of employees. And from a South African perspective, the regulator has defined certain public interest entities that they have deemed to be a PIE, and those include, for example, pension funds, etc., with assets under management of, I think it's 5 billion rand or something. So, significant entities. In terms of then just understanding then and applying some of what we've learned, what I'm going to do is I'm going to post in the chat a link. If I can ask you to click on that, and that will then take you to a quiz just with 2 different scenarios that I'd like to discuss with you to see how we've understood that, and to see if there's anything further we can discuss and learn from these case studies. So if you can go to your chat, I'm going to be posting that right now. You should have a link to a question, to some Microsoft Forms questions. They'll look something like this. So if you can just go through the questions, and then we'll be discussing that, what your thoughts are. Okay, can I just have a thumbs up if that's come through? Just checking, has that come through? Are people able to access that quiz? Great, thank you. So I see some of you still submitting your responses. So I'll just give you another minute or two, and then we'll go through the questions. Okay, if you are still busy, you're welcome to continue, but I do think in the interest of time, it's important that we do start going through the information. So in terms of the first point, first question, CA is employed by a law firm. The branch does monthly returns for the client's law firm. The CA is also required to sign off on compilation reports on the financial statements that it's doing. And he signs off as Mr. XYZ, CASA, law firm branch, etc. He's not a shareholder or director of the entity he's employed. Is this acceptable in terms of the code? So from a perspective of compilation, we need to understand that a compilation is a non-assurance service, and therefore this would not be prohibited by the code. This would be deemed to be, from a South African perspective, internally compiled financial statements, and there would be no concerns around the person carrying on such a activity. Don't know if there's any questions or any further discussion on the first point, the first question. So most of you getting the answer right. Okay, I can't see any hands going up. So then, if we can move on to the next one, and here, an audit firm uses the services of an independent sole practitioner for the compilation of financial statements for statutory audits that it performs. May the sole practitioner accept or enter into a contract with the audit firm as part of an engagement team on other audit or review engagements? So some people saying yes, no problems. And then quite split between only with safeguards or other people saying this is totally prohibited. So what I'd like to ask, I don't know if anybody who said with safeguards is willing to discuss, or you're welcome to put something in the chat as to why you believe it was with safeguards. And for those of you that said it was prohibited, why? Prohibited, what's the principle that's being breached here? And those of you who said yes, why do you believe not? Anybody willing to, or you're welcome to unmute yourself, and I'm happy to take a discussion on this. Any thoughts? Anybody want to submit something or raise their voice? Okay, so Louis Torres is saying that there's no conflicts. So does that mean that that would be definitely allowed? Thank you, Louis. Any thoughts? For those of you that say it is prohibited, what conflicts do you see? And those of you saying there's safeguards, obviously you see threats. So what safeguards would be applicable? So comment saying that with adequate safeguards, it would be borderline. If in doubt, perhaps that is to be considered. Also, do not see what the huge conflict of interest is. So I think it also depends in what jurisdiction you operate. Because from an international perspective, concern being expressed, another comment that there could be a familiarity threat. I think the potential here, and we need to look at it from an international perspective as well as from a local South African perspective. And I do see a potential familiarity threat as well as a potential self-review threat and possible network infringement as to, the question reads, the audit firm uses the services of an independent sole practitioner for the compilation of financial statements. This seems to be taking on a management responsibility because it's the entity's responsibility to perform and to prepare financial statements, not the audit firm's responsibility. And, if they are referring all their work to this particular sole practitioner, the concern is whether or not this practitioner could be viewed as part of their network and therefore an extension of the auditing firm, and then that would be prohibited by the code. Whereas if, however, the entity, the practitioner has an independent relationship with the clients, which I don't think is the case from the wording of this, which was carefully chosen. But if they did have an independent relationship, then I do believe that it could be set up with appropriate safeguards, that they don't have access to any of the information. They're not part of the team. They're not part of the network of the firm. And therefore, there would be a allowance to carry that out, and those safeguards being independence requirements, restriction of access. I do not foresee, I don't see a familiarity threat directly just because they're associated with a firm on some other engagements. But I do think if all their work is being going to this client, there may be almost a independence created in that regard. I don't know if there's any comments or anything else that anybody wants to raise. Sorry, I'm just looking at a different screen. Just easier when I look at these responses. We shouldn't be much longer. We should be finishing off at 12 o'clock. Right. Then in terms of the final scenario, had an employee that worked for 18 months, dealt with one of the biggest contracts, and she left the company and joined a company, the opposition. And this person now reviews the work of the contract and is involved in the commercial dealings. She also requests information and analysis on subjects that she used to work on our side. Is this ethical? So it's interesting. Most of you saying this is prohibited. And I think if she's utilizing software, templates, and information that was developed by the firm at which she was employed, we are all in agreement. If, however, she is just utilizing, which I don't think is the case, but she would be allowed to utilize information and skills that she's obtained in her new role. And that would be something that would not be prohibited.
Sorry, Edwin.
Yes.
We are obliged to join meetings 5 minutes before they start, and it's 12 almost. So a lot of us are going to be in trouble. Is it okay if we leave?
Yes, that's fine. I'm done, actually. I was just going to ask for any further questions, but I am done. There will be a quiz that will be sent through to you, so no problem at all.
Cool.
Okay.
Thanks a lot.
Thank you. Don't know if anybody's got any other questions. Okay, if not, I'll just stay on line for a bit longer, if there are any. Otherwise, you're welcome to get hold of me through W.consulting.